Well, 2025 ended up being quite a good year, didn't it, Husey?
Yeah, I think
clients should be relatively pleased.
Definitely double-digit returns. Yeah,
double-digit returns again, pretty much.
Yeah, I think. Am I surprised by double-digit? I'm definitely surprised. I would definitely have been surprised sitting in the middle of the tariff tantrum.
Yeah. Agreed.
I think I'm more surprised by probably UK and Europe. Nicely surprised.
Well, we'll get into it. We might as well kick off, haven't we? There's
Yeah. Are we recording, Alex?
Yeah.
Fine. How was your Christmas?
Christmas was good, thank you.
Yeah.
Yes, Christmas was all right. We were at home, and then we went down to Mum and Dad's for New Year in Wales. That was good. My kids were delighted with everything, and it was exciting, and nothing drastic went wrong. Christmas lunch was pretty good.
Did you cook?
I cooked. Thank you very much.
Did you?
Yes.
Turkey?
Turkey was superb. The local butcher, Ferny Grove Farm. Shout out them, Berkshire.
We did the local butcher as well, and we had a turkey crown with wrapped in bacon.
Oh,
it was absolutely fantastic. And I finished the last bit last night for dinner. I basically ate probably half the turkey myself because we only had a few of us on Christmas Day.
Lean protein, and athlete like you, Husey.
Thank you very much. I'll take that compliment. It's unusual from you.
Did you get much training in?
I did. We had a really good ride New Year's Day. We met in Richmond Park at 6 a.m.
on New Year's Day.
Yeah, we didn't go out New Year's Eve. And we rode around London, saw the sights, but of course, no one's on the roads.
Oh, that's cool.
Really cool. So we rode.
It was dark at 6 a.m, wasn't it?
Yeah. Met in the park, rode out of the park, Roehampton Gate, and then through Barnes, over Hammersmith Bridge. Then we went up to Notting Hill, cycled down Portobello Road.
Oh, nice. Literally
nothing open, no cars, no pedestrians. Then we went through Kensington Gardens, which was lovely, Kensington Palace. Then we did Regent's Park, inner and outer loop. Then we went down to went up to Camden and did the coal shed. There's a lovely area lovely shopping area. Went all around there.
Very well.
Then went into the city, up to Tower Bridge, rode over Tower Bridge,
good.
all the way back, and then through Bassett Park. And lovely.
Oh, brilliant.
About 8 of us.
That was a good route, that.
It was loads. Do you know what? It was loads of fun, actually. So got that done, a bit of training. But it's been very cold.
Good job you got a garage then, isn't it?
I've been in the garage on a turbo. It's even cold for that. I'm sort of in there on winter gear.
Yeah, well, I got some weights in the garage, and it's I do have a space heater, but it doesn't seem to do a lot.
No.
But of course, you heat the air up, but everything is cold to touch. So you pick some weights.
The weights are
freezing in your hands.
Yeah. And how's your marathon training going?
Half marathon.
Marathon.
It was on my. In fact, it was on my. It was on my list of predictions / resolutions for 2025. My half marathon. So I did one in February last year, and I'm doing it again in February. So it's going okay, thank you. Yes. Your 2025 resolution was to try and be a bit more glass half full. How did that go? Don't want to laugh.
I would say I failed.
Well, you've always got a smile on your face, Easy. So that's the.
In general, I think my New Year's resolution this year is going to be less cynical. Which
that's the problem though, because it kind of comes with age. My sort of feeling, but I do agree with you. The cynicism does wear thin after a while.
I do need to be less cynical. I think I'm going to go for the same resolution. Be a bit more glass half full, a bit less cynical. I mean, it's been 2025 was a great year. Had lots of reasons to be cheery, but no, I don't think I was too bad.
Good. The other one of mine was more holidays, and I definitely succeeded in that.
Did you? You had a few golfing trips.
Well, as ever. So we would, yeah.
And you're Australia soon?
Australia end of March, just before the end of the tax year.
Okay. Is that done for the Easter holidays?
Yes, 2.5 weeks.
Yeah, you don't really want to go there any less than that.
No, too far to go.
Is that see your sister?
My sister's there. She's 50 this year, so we're heading out to visit her.
Your younger sister. It'd be nice to catch up.
Yeah, thanks, Easy.
Wait, that jump
is... Oh, dear. Honestly. Right, should we get started? We've got some charts to go
We
through.
should do, really.
Hi, everyone, and welcome to Taking Stock After the Bell, episode 58. We thought we'd review 2025 and the year that was, and we've got some charts to help us along the way and some insights from Husey, no doubt. So, as we sort of touched on, a few resolutions from last year, and we can kind of half tick those off, right?
I think so.
Yep, good.
You did probably better than me.
Predictions. We'll come on to Husey's prediction after. Mine was in the vanguard of going out on limb. I said, and I quote, "Another solid year with some wobbles along the way."
I mean, you've nailed it.
And I also said I'd be surprised if the US equity market did another 25%, which it didn't do.
No.
So there we go. So I'm going to put a tick next to this.
But what did it do? 18.
No,
in dollars.
Oh, in dollars did 18, 20, yeah. But not 25.
No.
But in sterling, we'll come on to it, only did 9.5. So careful what you wish for.
My prediction, which I think was very good.
Go on then.
I said the S&P would do double-digit returns, which it did. Technically, yes. My other part was that the broader market would outperform the Mag 7, which, I mean, technically I'm wrong, but only two of the Mag 7 actually outperform the S&P, but due to Nvidia's weighting and Alphabet as well, actually, if you take all of them into account, the average return was better.
Yeah,
marginally.
It was 5% better.
Yeah,
but that's fine. I'll give you half a mark. But I don't think we need to put this slide up. But effectively, growth. I mean, diversified investors had a good year, 10% or thereabouts in sterling terms for medium-ish risk clients. Whatever medium risk means, it's sort of classic 60-40, I guess.
Yeah,
growth was okay despite the tariff wobbles. Inflation. I mean, we'll put this chart up. Slot 3, Alex.
Yeah.
Inflation has come down a little bit. Particularly in the UK, but in the US, it's still pretty elevated and going the wrong way, 2.7%.
Yeah.
And some of that is caused by the tariffs and goods prices going up.
Service inflation is coming off, isn't it?
It's coming down, yes, but it's not coming down enough to offset the goods prices increases through the tariffs, which are still feeding their way through slowly. So we'll see.
As we mentioned earlier, Trueflation, which for those that haven't heard of it, is an independently run website and business, takes into account about 100 million data streams and points. That has US inflation at just under 1.9. So, and that's more of it's a snapshot, isn't it? But that's probably more realistic.
Probably, yeah. And then because inflation was coming down, central banks have brought interest rates down as well in 2025. So next chart here, we've got UK rates in blue. Yes, blue.
Yeah.
Have come down from 4.75% at the start of the year to 3.75.
Yeah.
US rates have come down from 4.5 to 3 3/4.
Yeah.
So 3 or 4 cuts there. European rates pretty much stayed flat, or they came down early in the year, and then they've bottomed out 2%. The chart here also, the blue bit has got a Reuters poll expectations of what they think rates will do, and interestingly, they see UK and US rates following a very similar path. Another 2 cuts this year, 2 or 3 cuts this year, to end the year at 3.3% in the UK. Which, if inflation does behave, then that feels sort of feels about right. Whereas last year, the market was expecting 6 rate cuts, wasn't it? I think in the US.
In the US, yes.
And only got 3 or 4.
Yeah.
So we'll see. As we said on the last pod before Christmas, we talked about the 2026 outlooks. Inflation was the sort of one major risk that people had, the sort of left field. Inflation makes a resurgence.
And we talked a bit about you only really have real problems with inflation when the oil price starts to spike. And I guess probably with what's happened in Venezuela, that might keep a slight lid on it.
Yeah.
Although Although, is that going to change the global supply? Not in the short term.
Not in the short term, no. It's a
mean,
long game to get
Yeah.
Venezuela back up and producing a decent amount of oil.
Yeah.
The other thing, I guess, is that any peace settlement in Ukraine, and
Yeah.
if any peace settlement was sort of dependent on, or if one of the conditions was Russia allowed to bring oil back onto the world market,
that would have
the
a
sanctions
change.
would cut.
Yeah.
That could potentially be a little bit more supply. So the experts in the oil market all say the oil market is well supplied, and therefore there is downward pressure on prices more than upward pressure. But things happen and things change. So that would be the kind of major risk. Really, would be inflation and rates not coming down as the market currently expects.
I think the other thing on the inflation front, particularly the UK, is quite often goods, particularly on food, are costing. It's not that different, but you're getting less. So instead of getting, I know it's probably a bad analogy, but 4 chicken breasts, you're getting 3.5.
Bit of shrinkflation.
Yeah, no, there definitely is.
Consumer staples companies are very good at that. Nestle, Unilever, etc.
Less crisps in my Walker's pack.
No, you're right. And I guess the other kind of major story from a sort of headline perspective was dollar weakness, which I've got a mixed chart here. It's slide 5. The right hand side, the green line, is the dollar index DXY. So it started the year 110. Which, remember, we started the year post Trump's election in November, and there was a lot of enthusiasm for US assets in general, and the dollar was up a lot. And then as the year went on, Liberation Day, and all that sort of stuff that called into question what they were doing in the States, has led to a severe amount of dollar weakness. So the dollar was basically down 10%. And then the left-hand chart here, we've got the blue line is sterling dollar. So it started the year at 125 and it's now at 135. And euro dollar has gone up a little bit more. So that started the year at 103 and it's $1.17. So
that was definitely not something that we expected at the start of the year. I mean, Trump did say he wanted a weaker dollar, but I don't think any of us expected a 10% fall in essentially the reserve currency of the world.
No.
And he's talking it down again, isn't he, for this year? He'd like it weaker again.
But if he wants stuff manufactured industry to come back to the US, a weaker dollar is part of that because it helps them export stuff to the rest of the world and makes imports more expensive. So it kind of is part of the grand plan, dollar weakness alongside industrial manufacturing renaissance. But of course, it does mean, as we've sort of alluded to, that yes, the US equity market was technically up 18%. However, if you're sitting here in the UK and you've got the S&P tracker in sterling, it was actually only up 9%. So the currency has had it doesn't often have a big impact on your returns as a sterling investor. And in fact, if you go back in time, dollar has been stronger against the pound, not weaker over the long term, particularly post-Brexit. So it's actually been a tailwind for your returns, whereas last year it was very much a headwind.
Yeah, and that's also impacting emerging markets as well, isn't it? And part of the reason the return was
pretty good
last year. Was partly linked to that.
And then the next chart we've got is a sort of broad, diversified, some indices, representative indices of different portfolio types. So we've got the red line is the cautious index. These are the ARC indices, asset risk consultants. They're not necessarily exact, but they're quite good sort of yardstick as to how diversified investors should have done. So cautious investors had a year of roughly 5.7% returns. Balanced investors, or the balanced index, was up 8.7%. The steady growth index, which is the one that most clients would probably be most familiar with, was 9.2%, and equity risk 9.7%. So, pretty much double-digit returns, 9-10% for the majority of investors last year.
I'm slightly surprised that balanced, steady growth and equity were so closely aligned when equity markets did so well.
Yeah, I noted. Yes. So
I know alternative assets had very good years. Things like gold. Some of the hedge funds had very good years. Bonds. We can go on to what bond prices did, but bonds were pretty good. But bearing in mind, equity risk would probably have usually it's 80 over 80% equity exposure, isn't it?
Yeah.
I'm surprised that didn't do better. I guess a lot of the
agreed.
allocation would be to the US.
Well, the US was 9% in sterling
Yeah,
terms. So maybe these indices got a heavy US bias to them, I don't know. But yes, no, agreed. But still, third good year in a row.
Yeah.
And
I mean, coming out of 2022, if someone said these were going to be the returns, we'd have bitten their hand off.
Yeah, absolutely right. But it's a bit gambler's fallacy to borrow a phrase, but the equity market goes up 3/4 of the time, or 3 years in full. And we've had 3 good years with the 4 years ago was a bad year. So yes, okay, in strict probability terms, you might expect a bad year after 3 good years.
Yeah.
And that's a bit simplistic and doesn't always work out that way. But if we're sitting here next year and we haven't had a good year, then we could sort of say, well, we had 3 good years before that. So, do a bit of a catch up. So that's just sort of a way of looking at it and to try and frame the expectations, I guess.
I think probably for clients, the performance is caught up with what inflation's done.
I think
CPI is probably, from the depths of
COVID.
What's that? Almost 40?
35, 30, 30 to 35.
So we're probably not far off that, actually.
Yeah.
So it makes sense the equity markets have done what they've done in if you look at it.
Yeah, no, that's a good point. That is a good point. And we should all think about real returns as opposed to nominal returns. And you have had to produce 30% or so in the last 4 or 5 years to keep up with inflation.
Yeah, totally.
So drilling into asset classes specifically here, we've got from the top, the UK equity market, MSCI UK, was up 24.6% last year.
We've been banging the drum on the UK, Jonathan,
we have been banging the drum. A certain index based in London has crossed through 10,000 last night. So that's good news. I can't see your 10,000 hat on, but must be on order. And UK equities did a lot better than global equities for the first time in what feels like a while. Global equities are up 14%. Obviously, that was in part driven by the US, which was only up 9%. We'll come on to some of the other sub-regions in a minute. The difference this year compared to the last few years is bonds have actually been a tailwind, not a headwind to returns. So corporate bonds are up 7% and UK government bonds in total return terms up 5%. Now that's exactly what you want your bonds to do, isn't it?
Totally.
You want 4 or 5% a year, minimal drawdown if you look at the chart. They did their job. Yield stayed steady and you got your starting return basically. And that's really encouraging from my perspective.
Yeah, and I think, if you think about equities this year, even if you're slightly cautious or expect them to not do much, actually with expected rate cuts coming, we should be expecting positive returns from corporates and from governments, again, which will balance out what the equity segment of portfolios do. So I completely agree that they're starting to do what we want them to do.
And just the only other thing that jumped at me on this chart was actually we've made, equities have made 15, 20, 25%, depending on where you've been invested, despite having a pretty meaningful drawdown in April. So if you look at that yellow line, it went from 106 to 86. So it fell nearly 20% from the end of January, early February through to the depths of Liberation Day. So you not only have you had a good year, but you had to weather a pretty horrible moment. I haven't gone back and listened to our Terrified Markets podcast in the middle of April, but it was, it was pretty scary, right? We didn't, there was lots on the table at that point. So if you managed to stick through that and you've managed to earn yourself 10, 12%, then I think give yourself a pat on the back.
Totally. Things felt pretty bleak in early
April. Definitely.
And then goes to show again, though, having a diversified portfolio and not panicking or selling off assets when things feel bad. Again, it's about staying invested in the market. We go on and on about it, but it's proofs in the pudding. And again, owning good companies and good asset classes provides good long-term returns.
And it wasn't just the AI stuff last year either, was it? So
no, this is what's really positive from my point of view. It's been the broadening out.
European banks, UK banks, Barclays, HSBCs, NatWest have all been brilliant. Obviously, the defense companies have been superb after the Germans are rearming. It's been widespread and broad in terms of your returns. And we've got we've broken out the global equities here into different regions. So the blue line is the UK, 24%, beaten by emerging markets in Europe, which were 25 and 27% respectively. Japan at 16, the red line, and then the laggard, the US, which is the first time we've said that for a long time, right? 9.6% for sterling investors. And again, if we look at that yellow line, look at the drawdown that we had from the end of January through April, it was 25% nearly, wasn't it? Yeah. So Europe, emerging markets, the UK, the winners, good year. Yeah, I mentioned some of the sectors there that have driven that. European banks have been phenomenal. Santander has doubled. UniCredit, Deutsche Bank, Mrs. Hughes's alma mater.
I saw yesterday for the first time ever, Deutsche Bank's book value, I think, was trading slightly above its share price.
Premium to book. First time in a long time since the financial crisis, I would have thought.
That is exactly it.
Right.
That's exactly
wow.
it. Yeah.
That's a good news. And that really is because the Germans are spending the best part of €1 trillion on infrastructure and defence. And that, you think about banks, that money has to go through the banks to get where it needs to get to. And a bank, all it does is it takes in money one side and gives out money the other side and takes a little bit off the top. Yeah. So more money flowing through.
Yeah, and in reality, the banks have been hamstrung since the financial crisis because of where rates have been. But they're operating in a more normal environment. It's taken investors a long time to realise that that's starting to happen. It's returns are improving across the board as loans that have been made at lower levels are maturing. There's recredit agreements. There's new loans being put together. So I think you can understand why the financials have done what they've done. It's nice to see. I have to say, it's nice to see emerging markets performing well because it's been quite a long time, hasn't it?
Yeah,
we've been quite positive on EM for a while, and really, we had the issues with China and that sort of dark cloud over EM, I think. But it's been good to see that growth coming through. Said the dollar has had some impact, but corporates appear to be trading very well.
Well, emerging markets were cheap in valuation terms,
very cheap,
and their earnings have grown quite meaningfully.
Absolutely.
So they've got less cheap, and their earnings have gone up as well. So they've had a kind of double bubble. And you're right. The weak dollar has been a real boon for emerging markets. That really does help.
Yeah, I think the other thing for me is lots of stories about how expensive the US is and the AI bubble and the rest of it. But actually, in valuation terms, the S&P's multiple didn't change from the start of the year to the end of the year. The growth that it saw was all through earnings growth, which is really healthy,
really encouraging.
I mean, yes, UK and Europe saw some multiple expansion, but we are expecting better earnings growth going forward, and I suspect again, valuations or share prices will grow into their valuations. But in the US, we talked a lot about this last year, which was, share price, basically earnings need to grow. They need to grow into the valuations they're trading at, and that's exactly what's happened.
Exactly what's happened. I've got an earnings chart a bit later on, but yes, you're right, and everyone is expecting 13-14% earnings growth again for 2026,
that's really healthy.
And it was about 13% in the US last year, and that's okay. Some of that is Nvidia and Microsoft, etc. But actually, a lot of that is the 4932. It's not just the Mag 7 driving the bus. And sales growth is good, and the US economy was fine last year, and growth is okay. People are spending money. So when sort of clients say, "Well, why is the stock market doing so well?" when you just read the news and it's terrible, well, the economy is doing okay. People are spending money, and companies are making profits, and those profits are growing, and that's translating directly into share prices. Talking of the US and the Mag 7, we've got a chart here of the 7 stocks. Lots of numbers and lines on this chart. The orange line, which I've tried to highlight in bold in the middle, that's the broad US market up 9.6%. The top line, the grey line is Alphabet, Google, which had a really stonking end to the year, was up 55%. Nvidia, the blue line, up 29%. So those are the only two stocks, Google and Nvidia, that beat the market.
Yeah.
The rest were all beneath. However, as you alluded to, the 7 as a whole beat the market because of those two stocks did so well.
Because of the weightings,
Because of the weightings. So Amazon was actually down on the year, which I hadn't realized. Apple was only up 1.5%. These are all in sterling terms, by the way, total return. What have we got? Tesla was up 4%. It was pretty volatile. It was down 50% at one point.
Yeah.
Microsoft 7.6.
Meta was tricky, wasn't it? Because it had a very good start,
Yep.
and then it sort of did the opposite to Alphabet, didn't it? With the large language model, I think some of the shine came off that a bit, and it had a bit of a derating towards the end of the year. So that was quite tricky because it was looking quite positive halfway through.
Well, this comes back to, we talked about it with Ben, but is AI in a bubble? Well, the market is being quite disciplined with these companies. So when Meta came out and said in October, wasn't it? The Q4 results, Q3 results. When they said they were going to spend an extra 20 billion, it was going to be 110 instead of 90. All of a sudden investors went, well, hang on a minute, where's this money going? Is it going into a big black hole? And there was a story of they took on some AI engineers from Apple and paid them $100 million or something.
Yeah,
some silly number.
Yeah.
And all of a sudden the market's gone, well, hang on a minute, this doesn't sound like you're being very scrupulous with shareholder funds. So that's why the stock kind of...
Yeah, I think for the first time ever, not first time ever, but first time for a long time, they're funding their growth out of debt, not out of free cash flow. And you look at debt to EBITDA, it's very low still. But you compare it to Alphabet and Microsoft, which are still cash flow positive. That is a difference. We haven't got Oracle in here, but Oracle does have a lot more debt than the others, which the market is being pretty cautious
discerning.
Over. Yeah, I mean Oracle, all of that gain that Oracle saw as a result of the agreement with Nvidia. With OpenAI. It lost it all, didn't it?
Yeah, gave it all back.
Yeah.
So it's going to be really interesting to see how that kind of plays out this year. I would think that a lot of these companies, the hyperscalers, the Microsofts of this world, will want to start seeing returns on this investment.
We talked about them having at the beginning of 25. We talked about needing to see the returns by sort of third, fourth quarter, didn't we? And that's been pushed back a bit. Although some of the returns are coming through. I mean, certainly for Nvidia, the returns are coming through, but for the hyperscalers, it's not quite coming through yet, is it?
No. And the other issue on the slate for this year, as you raised the other day with Ben, was some IPOs. So are some of these private companies going to come to market?
Yeah.
OpenAI could potentially be the biggest IPO in history at the best part of $1 trillion.
Yeah. And then we've got
OpenAI, of course, is the owner of ChatGPT.
Yep. And then we've got
Anthropic, which owns Claude.
Yep.
And
then SpaceX.
SpaceX, yes, which owns the Starlink.
So, the point to Ben, our tech analyst, was you've got to fund. If you're an asset manager, fund manager, hedge fund, you've got to fund these positions. If you want to take part in the IPO, and you don't already own the stock, you need to find the money from somewhere.
You've got to sell something.
And the likelihood is it doesn't come out of your industrials or your bank holdings.
No.
It comes out of your more growthy stocks. So do Microsoft, do Alphabet, do Nvidia get trimmed in order to fund these new positions?
And how much appetite do investors have?
Yeah.
Because that's what characterized 99, the dot-com boom, was that every day there was an IPO that investors were just throwing money at.
Yeah.
And my sense is that these are potentially some quite large IPOs, and it will be a good indicator of sentiment, whether they get well funded and whether they pop on early on. We'll see. That's going to be fascinating to watch, I think.
It is. I mean, the other market I think looks, it's tricky to know what it's going to do. Is Japan. There's a lot going on there. They've got
new prime minister.
Yeah, new prime minister who's quite growth focused. You have inflation for the first time.
Yep.
Or the central the central bank has increased rates for the first time in
20 years.
25 years.
Yeah, 30 years. Yeah.
So, but they have this huge amount of outstanding debt. It's what happens there, I think, is tricky, because at the same time, corporates are really changing their behaviour and starting to act in the interest of shareholders. Whether that's buybacks or returning of capital or just investing in the right way. Don't have these sort of cross holdings. That's all being tidied up. So it looks quite interesting. But debt to GDP is
250% government debt to GDP.
Yeah, and the central bank owns 60% of
the debt.
Japanese bonds.
Yeah, yeah. But we've got a chart of bond yields here actually, and that it does help to highlight. So the blue line here is the UK gilt yields. Started the 10-year started the year at 4.5, ended the year at 4.5. Went a bit higher in the summer. US yield started at 4.6 and ended the year at 4.2. Germany is the second most interesting line on this chart. Started the year at 2.4, ended at 2.9. If you look at the end of February, my notes say here that the announcement of the German infrastructure plan led to the biggest one-day rise in German Bund yields since reunification. So yields must have went up 30 or 40 basis points over the space of a few days, and you can see that on the chart in end of early March. Yeah. And they ended the year at 2.9%. So, the Germans, which historically have had very low debt levels, 60% of GDP, they are pushing that number up as they spend a lot of money. Yeah, yeah. And then the most interesting line, as we've just alluded to, is Japan. Started the year, the 10-year Japanese government bond started the year at 1%, ended the year at just over 2%, and has been going up as interest rates have become more normal. Inflation is there, as you say. So UK and US, good for bondholders generally. Positive returns, 5% returns on gilts. Yeah, I mean, certainly better than it was in the 10 years post-financial crisis, 15 years post-financial crisis. You're looking at normal rates now in the UK and US, and something for investors to get a hold of. But, again, we talked about one of the risks for next year was inflation making a comeback, and that would have an impact on government bonds.
And actually, holders of that Japanese debt would have really hurt, because seeing yields go from 1 to 2, we just go back to when UK yields went from 1 to 2.
Yep.
That is big percentage
big negative
falls.
Impact. Yep. So we'll see. I mean,
fortunately, you didn't own any Japanese bonds, PA, did you?
No, it's not part of my PA allocation, funnily enough.
Just Bitcoin.
Talking of alternatives, a couple of tidying up pieces. We've got some commercial property. So this is the UK listed real estate investment trusts, up 10% total return. Commodities, the Bloomberg Commodity Index in sterling, as illustrated by the iShares Diversified Commodities Swap ETF, as a mouthful, was up 8.5%. Again, good end to the year, driven a lot by precious metals, which we'll come on to. And then HFRX, which is a global hedge fund index in sterling, was up 7%. You can see that line was pretty steady, as you'd sort of expect with hedge funds. So that's fine. I mean, UK REITs were a little bit wobbly in the middle of the year. And then on the commodities, just kind of zooming in on commodities, busy chart, sorry. The oil price is the black line, or was it blue? I can't really tell.
Dark blue, yeah.
Dark blue was down quite meaningfully. So it started the year around $75 and then ended the year at 60. And we've got the shenanigans over Venezuela since this chart was produced. The goldy coloured line obviously is gold, which was probably the star of the show. What was it, up 60, 50, it's 60, 70%?
Yeah.
Up a lot. Yeah. Copper also had a really good year. So that was up about 30% as well. So that was good. And then really the puzzling one, you'd expect, equity market was up 20%. Everything was good. Bitcoin was down, which is...
I know it's been seen as, I mean, for a long time it correlated to the NASDAQ, didn't it?
Yeah.
And then it
risk on. I mean, it should be a risk on asset, shouldn't it?
It should be. I mean, some commentary over, I mean, we had a few things. We had China pushing quite negatively against it and changing some of the regulations around its usage and being able to hold it. Apparently Germany had a lot of Bitcoin and had been selling it. We talked about it before we started, it had a pop yesterday, which apparently Venezuela have over 3% of the supply in treasury, and it's been confiscated by the US. So essentially 3% of Bitcoin supply has been removed from the market. So again,
Didn't know
this is
that.
just
3%. It's a lot.
yeah, it's just I think they're third or fourth largest holder,
Right.
which no one really knew. So it's it's been I mean, it had a very volatile year again, but it's sort of all the way, sort of the various ways people thought about Bitcoin and how it's correlated and how it should price and move. It has broken down. So it's fascinating, really. Again, not an asset we own, but we certainly keep
Keep an eye on it.
keep an eye on it, as you say.
We'll see how that develops this year. It's had a good start to this year, though. It's up
Yeah.
7% or so
Yeah.
so far in 2026, and we're only a week in.
Yeah.
So we'll see. Closer to home, a few more housekeeping-y things. We obviously had the budget in November, possibly the longest lead into a budget ever.
We did.
In the end, it was a bit of a nothing burger.
Bit of a damp squid, wasn't it?
But obviously, taxes are going up, mainly by fiscal drag. Cut to the cash ISA limit and dividend tax and income and rental, buy-to-let rental taxes are going up as well. Property prices in the UK were basically flat, 2 to 3% growth. London was underperformed. Mortgage rates are coming down, though, just in time for your refinance, easy.
No, October 26th.
October 20. We're August 26th, so we'll keep a close eye on that. So that's good news.
Yeah, I think you can get 3-year fix at the moment at 3.5.
Right. Okay.
Apparently
3.5. Well, there we go. That's a lot better than what we were looking at potentially.
Yeah.
So, in the end, the mood music in the UK has not been brilliant. Growth in the UK will be about 1.3, 1.4% this year, which is okay. Better than what we expected a year ago, or what consensus expected. And consensus for this year is equally dull, 1%, I think, or so. As
then a
tax
recovery
rises.
into 27.
Into 27 now.
But that's always
the case, glass half full.
Yeah.
So, I mean, there's, I'm sort of feel that the UK could do better if, households in aggregate have got a lot of cash in the bank and they are saving a lot of money. And if some of that savings was deployed, the economy could pick up. The housing market's been, dire for the last 12, 18 months. And a lot of that is kind of policy induced / concerns over tax. And again, if that, clears and maybe the, people go out and start making decisions, and maybe the economy looks a lot better quite quickly. We had Next results this morning, didn't we?
Very good.
10% year-on-year growth in sales. Doesn't necessarily tell me the UK economy is on its knees, but it's mixed out there. So we'll see. But hopefully it'll be a bit quieter on the policy front this year. We haven't got to worry about taxes going up every 5 minutes.
Yeah.
Which is what it felt like last year.
I think we're hoping for slightly quieter times in political world as well, but we've started off the year with a bang with Venezuela, haven't we?
Yeah. And we're going to have elections where this year? We've got midterms in the US later in the year.
Yeah.
We've got elections in Germany? No. France, surely. France must be an election in France.
They must have a couple.
So, there's always stuff like that going on. We'll see. But generally, I think investors should be pretty pleased with what ended up being a decent year.
Yeah, totally. And I think, what would really concern me would be if the US had another monster year without the earnings to back it up. And that's not been the case. I think there's a bit more interest in global markets. UK, as we highlighted, UK, Europe, EM, investors getting more excited. I think starting to look through the opportunities. Lots of notes coming in about how cheap UK small and mid cap still is, and lots of PE takeovers.
Yeah, well, that was going to be one of my predictions for this year. Is we get more PE private equity driven takeovers, particularly in the UK mid market. And we had quite a few in 2025, to be fair. But I suggest that will continue, and I also think there'll be some IPOs in the US as well, as we talked about.
Yeah.
It's being pretty quiet on that front. So I just think capital markets will wake up a bit. There'll finally be some confidence to get that going. And interest rates are modest / coming down. economy is doing fine, and it doesn't look like the economy is about to fall over in the US particularly.
No.
And earnings are going up, and it's very difficult to see how equity markets go down in that situation.
Yeah.
Unless you get, obviously, an event, sort of.
Yeah, I mean, historically, interest rates being cut into an economy which doesn't have a recession is very supportive.
Yep.
Equity markets always go up.
Yeah. But the flip side is that valuations are already relatively high in the States. So if those expectations of 15% earnings growth aren't met, then you've probably got some sort of issue in the equity market, and you get a bit of a reset. And again, interest rates, inflation, interest rates, and bond markets probably hold the key. If you get a kind of inflationary spike that comes through, and the Fed don't cut rates, then the equity market probably stalls a little bit.
Yeah. I mean, in terms of predictions from sell side, it's always the same, which is kind of S&P plus 10%. Now, I think there's still opportunities in the UK and Europe. We haven't really seen the benefit of what Germany's going to do yet. That big infrastructure spend could be quite exciting still, and EM still looks cheap. So I think there's lots of opportunities still. It goes back to having a diversified portfolio.
Yep.
I wouldn't want
Totally
it in one
agree.
area.
Totally agree.
I think on a starting point, I think things look fairly positive. I'm not going to say
more of the same, isn't it?
I think so. Or positive markets with a few bumps in the road.
There'll be some volatility along the way. Oh, shoot me now! Oh dear.
Buy the dip still.
But always, because the long term chart starts in the bottom left and is in the top right, and it keeps going that way over 150 years of history. So, past performance is not indicative of future returns.
It will be interesting to see what the likes of Amazon do, because in quite a positive US market last year, to see that type of stock not doing anything, it's quite unusual.
Yeah.
Then we discussed it before. It's I think the businesses we're referring to, the Amazons, the Apples, the Metas, the Microsofts, the Alphabets, they've sort of had their own moats. Alphabet's had search. Obviously, Amazon has had online retail. Yes, it's had cloud, which it's been competing against with Microsoft, but it's a very big universe it's going for. But they're all starting to compete in the same arena
Agree.
now, and it's the AI arena, and some of this capex will be wasted, and there will be winners in certain areas. So I think, it looks quite obvious, but the ultimate winner looks like Nvidia or a Broadcom, or that goes down to TSMC and ASML. But it's what happens with the hyperscalers. That's tricky. But again, I think the market's been quite rational with its pricing.
No, it has been.
The hyperscalers we're talking about, with the exception of Alphabet, which Alphabet at the beginning of the year was priced to not to fail, but search growth or search was negative because of the AI. Yeah, because of the AI applications. But actually, that started at a very low valuation, so some of that is re-rating, but the rest of them all underperformed. So I think they look interesting on a relative valuation. I mean, Microsoft looks cheap. Amazon certainly looks cheap.
Well, they don't look silly, do they?
No, they don't.
And if those stocks grow at 15-20% and their valuations are 25, you would expect to make good money as an investor this year, because you wouldn't expect the valuation to fall out of bed.
Yeah.
So we'll see. So some of those, I'd still be a bit hesitant about some of the more speculative end.
Agreed.
Yeah, sort of, your biggest holding, Palantir, those sorts of things. And I don't think, as an investor, yes, you can play in those, but it doesn't need to be the core of your portfolio, a list of those names. You can play around the edges in some of those names if you feel inclined to do so, but kind of good luck, because they do whipsaw around 50% or so.
Yeah.
So I think the core stocks look fine. The economy goes okay and earnings continue to grow. That's a decent backdrop. And if anything impacts on that, then we're probably looking at an issue.
Yeah, agreed. Yeah.
I think we'll. And then resolutions, Husey, got any?
Glass half full.
Glass half full. Good. Well, I've deleted Instagram off my phone.
Have you? I did that at the beginning of last year.
Yeah.
And
how long did it last?
It's still deleted.
Good.
I didn't just delete the app. I deactivated my account.
You did it? Oh, really?
So
okay.
I lost all the, the 6 photos I had up. And
you're on a bike,
basically.
You standing next to a bike.
Yeah, exactly. Yeah. I think it was one of the kids.
Yeah, one of the kids.
I don't. There's other things that are more useful to read. I don't need to flick through.
You just
memes.
Find you've lost 20 minutes of your life looking at all sorts.
What other resolutions? I don't know. I haven't much of the same. I think keep up the fitness. Try not to eat too badly. Maybe I'm going to eat better this year.
Okay, good.
More greenery.
We got given a load of chocolate for Christmas from family and things. I'm like, well, what are we going to do with this?
Bring it to the office.
To eat it, don't we?
Bring it to the office.
Well, that's a good idea. Get rid of it that way.
Yeah.
But that's always the case, isn't it? Be a better human. A bit more gratitude, I think, is always quite a good one.
Yes.
We always get worked up about trains being cancelled or the coffee machine not working.
It's hard.
Spend
more. I'm gonna. I think try and spend as much time. I've sort of had. Yeah, thinking about the children. At some points, probably in the not too distant future, they're not going to want to spend any time with me.
Yeah, you're absolutely right.
Charlie's 7, Lily's 5, and they're so much fun.
Turn into teenagers soon.
I think it's just, we do spend lots of time with them, but it's to try to give them even more time because when they get to, I don't know what age, 13, 14, or maybe even 12, they'll want to be out with their mates.
That's not cool anymore.
That's not cool anyway, but yeah.
Come on, they'll be like that. Right, we'll leave it there then. Good luck to everyone on their investing journey in 2026.
Yeah.
And that includes you, Heezy. And we will hopefully got a guest lined up in the next few weeks. And then we'll see how the year goes, whether we have to do some, I don't know, emergency podcast because Trump does something or something happens. We'll see. But thanks very much for watching and listening. Any questions, let us know. james.hughes@courtachievia.com and I'm jonathan.raymond@courtachievia.com. And we hope to see you next time. Thanks very much. Bye-bye.
Thank you.